Paycom Software continues to crash, down 52% over the last 12 months. It is down to a new 52-week low, and this is a company that we did review not too long ago when in fact a famous hedge fund investor, Terry Smith, added this to his portfolio, as we can see for the Fundsmith. And today we're going to revisit this, take a look, understand whether or not it's a golden opportunity to buy given it has dropped significantly low, with a forward P now at under 19, below the S&P 500. And we're also going to take a look at their recent investor presentation, how they've performed, if we can spot any trends, and also try to understand why they are down after reporting some very strong earnings. Now we're also going to discuss quite a lot of insider selling that we have noted from the CEO. We're going to talk about insider buys as well as essentially the massive amounts of selling that we've seen. We'll also look towards the institutions, both buys and sells, to see where the trend is for this company. And whilst they have just started to pay a dividend, we will look at some very, very strong metrics. Their free cash flow, their balance sheet, their ROIC, it is looking very strong for this company. And we just want to remind you of how good this company numbers are. Top line growth, bottom line net income. Is this one of those companies that we are now seeing at a bottom and could be an incredible opportunity? We'll also look towards the health of this company. It is very important to understand that they have a phenomenal balance sheet, and we want to show you that with the numbers. And ultimately what we want to do is run it through the valuation model. We want to get to our updated intrinsic value. We want to look at our acceptable buy price given our investor margin of safety, and we also want to see what are Wall Street forecasting now after their earnings, after the continued drop. Is there some nice implied upside over the next 12 months? Now, before we report into their numbers how well they've performed, first thing we want to say is we do have only one buy rating from Seeking Alpha, a double hold from Quant and Wall Street. As we mentioned, a forward P around 18.7. This is one that has recently started to pay a dividend on a trailing 12-month basis. It does sit at 1.03%, and even though we can see it is at its 52-week low, it's been absolutely battered down 52%. If you've been a shareholder over the last 10 years, you would still be up very strongly, 944%, and in fact all-time highs, as we can see, around $550 nearly 3 years ago. So let's try and understand whether or not it will come back to these numbers and just the overall technical analysis of this company's numbers. Now, first thing that we want to take a look at are their earnings report, 1st of May, for those that did miss it. The headline, as we can see, their Q1 revenue, $500 million was what they reported. Now, this is up double digits, so 11% from Q1 of 2023. And we'll also take a look at how they performed on the bottom line as well. In fact, if you do want to compare it, as we mentioned, top line revenue, 10.7% increase, prior year revenue number of $452 million. When we look at their bottom line net income on a GAAP and not GAAP basis, we do note they have also beaten the same quarter from last year. In fact, 437 on a GAAP basis versus 206 from the previous year. On a non-GAAP basis, 259, as we can see, a marginal increase from 246 in 2023. We also note their adjusted EBITDA was up as well compared to the previous year, 221 million versus 230. So overall, these are some very strong numbers. Now, we will get into the essential balance sheet numbers like the cash, like their debt in a lot more detail. And we can also see in terms of their numbers and their forward guidance, they are expecting that growth to continue. And we will take a look at this and compare it to when we look at the deep dive on the revenue figure. But we also want to draw your attention to this article that was just released a few days ago, even though this company continues to fall. And what we can see when we take a look at their numbers, as we mentioned, they did not just beat these same numbers from the previous year, but also versus the analyst targets, 259 versus 243 on the earnings per share. And when we take a look at their revenue, they did beat 499 versus 495, not just analyst estimates, but as we can see as well, they did beat on management's guidance. Now, they do go through and they talk a lot about this company, their balance sheet, their cash flows, which are looking very strong, which we will put a graph in front so you can see it very soon. But they also take a look at their guidance, and one of the reasons with this company as to why we are seeing some short-term movement could be down to the fact that the market is anticipating that they aren't going to hit those guidance that they are estimating for the future, both in terms of the revenue numbers at 1.86 to 1.9 billion, as well as the EBITDA and the bottom line earnings per share. Now, in terms of the outlook, as we can see here, they do believe it has been broadly trending downward for the stock. So now let's take a look at some of their numbers. Now, the first thing we want to point out, on a top line revenue basis, as a minimum baseline, we want 3 to 7%. 151 million reported in 2014. We're seeing some very strong growth, more than 10 times to 1.7 billion. And as we mentioned, they are anticipating the full year 2023 to be north of 1.8 billion. On a graphical basis, just look at that consistency to their top line increase year on year. This is a very strong and consistent company if we are looking at it from a historical basis. When we take a look at their bottom line, again, you can argue the same. 5.7 million in 2014, 341 million in 2023. And again, when we do look at that on a graphical basis, whilst we do know the COVID year of inconsistency on the net income, from that point it continues to move in the right direction. So overall, their income statement is looking very strong on a historical basis, but as always, we shouldn't get caught up always in the past and always look towards the future as well when considering our analysis. We then want to take a look at the health of the company, their total cash versus their total debt. 25 million in 2014, 371 from their latest quarterly report, and we can see over the longer term their cash balance has increased, sitting on a fairly decent amount. Now, the reason why we say that is because we've seen the total debt in isolation. The cash number doesn't really mean anything. We always have to compare it numerically and directionally to total debt. And what we can see, it's gone from 27 million in 2014 to their latest quarterly report of 0 debt. So that is very strong. A company that has no debt on the balance sheet and a fairly sizable cash position. If you do want to see it as well, you can see that whilst it has increased over the longer term, it is now sitting around 0, which is a lot lower than the cash balance, which is looking healthy for this company. We then draw your attention to the earnings per share. Now, a few things that we want to point out that we typically look for on this channel. How have they performed in the past? Well, last 4 quarters, they've beaten analyst targets, so a 100% track record, things that we do love to see. Moving forwards, well, just to note, the next 3 quarters on a year-on-year basis, they are anticipating low to mid-single-digit decrease. They're anticipating, though, in quarter 1 of 2025, high single-digit increase year-on-year. And just a few things to understand with this company, as we will draw on this when we do look at our margin of safety and our valuation. And when we take a look at their earnings per share moving out to December 2025, we can see the forward PE will be estimated to be around 16.41 if they do hit that. And you could argue their track record is very strong, so you can gain some confidence within that. So overall in this section, we would just point to their track record 100% over the last 4 quarters. Now then we move on to the valuation grade. Now they get a D+. Few things that we want to point out. First one, P on a non-GAAP basis, 18.7 versus the sector median, so companies in the same sector and the similar size, 18.75. So not that far off it. If you are to look at other methods of valuation, as you can see, they do get between a B to a D depending on which one you look at. If you're looking at a price to cash flow, 16.44, it is higher than the 13.22 of the sector median. Whether or not, though, you will be able to justify that it is a higher quality company than those that are grouped in the same sector, that is something else that we have to consider as well. We then move on to the growth grade. Now they get a C overall. Few things that we like to draw on is the revenue growth year on year, 18%, a lot better than the sector median of 5. On a forward basis, 15, double digit, a lot better than the 6%. And if you're looking at the earnings per share growth over the next 3 to 5 years, they're anticipating an annual growth rate of 10.35%, marginally lower than the 11.5 of the sector median. As we can see, other metrics here as well if you do want to take a look at growth. But overall for this, they do get an average of C. But from what I can see in terms of the year-on-year as well as the forward-looking revenue and the earnings per share, it doesn't look that far off the sector as a whole. In terms of the profitability, well, this is where they really come into their own. An A-, we can see gross profit margin 86.5%, a lot better than the sector median. Bottom line as well, 27%. This is head and shoulders above that at 6%. And if you do want to look at their cash from operations, well, 488 million, slightly higher than the 312 of those in the similar sector. Now, whether or not you believe it is justified, as we can see, one of the downsides to this valuation metrics was the valuation. But remember, this is grouping them as a whole to give an average grade. Just for conclusion then for this part of the analysis, 1 buy rating from Seeking Alpha, a double hold, D+ on valuation, C on the growth, and A- on the profitability. And we'll talk about the valuation when we do put it into the valuation model itself to give us a direct answer. Now, for those that always like to look at others in the sector in terms of a similar performance, in the human resources and employment services, we have Dayforce, Paylocity, Robert Half, Adecco, and Trinet Group. So over the last year, no surprise then, and this, remember, includes dividends reinvested, so total return. PAYC, the worst performing, down 52%. Over the last 5 years, if you were to essentially reinvest as well, down negative 25%, again making it the worst performer. But if you do zoom out to over the last 10 years, as we can see, even after the 50% drop just over the last 12 months, it is still the best performer, up 955%. Now, I do always say this, but it is very key that past performance should never be used as an indicator for future performance, but the information is there just to see how it has performed against others in the sector over the longer term, as well as the short to medium term, as we have just analysed. Now, before we run into the metrics and talk about the dividend amongst other things, let's just take a look now at the insider ownership. It does sit at 12.6%. One insider has bought over the last 12 months, just under 50,000, although we see 3 insiders selling 1.82 million, and in fact you only have to go to this quarter to see a lot of insider selling. Now, for those who don't know who have been selling it, well, we can clearly see the CEO pretty much throughout the whole month of May has been selling a lot of shares, as we can see, pretty much in tranches of 1,950, and we can see the sales price every time he has sold, it has started to go lower as well. Whether or not you believe this to be a bearish signal, it is the CEO at the end of the day. He is a lot closer to the numbers than we are. Or if you believe that there are other reasons, personal or financial, that is up for you to deduce. But we have the information there. The picture is clear. The CEO himself has been selling a lot of shares just over the last few weeks. We then move on to the institutional ownership, 88%. We see 1.45 billion worth of sales by the institutions over the last 12 months, but we do see a fair amount more of buys, 2.14 to be exact, over the same time period. And we can see even in the more recent quarter, Q1 of 2024, more buying than selling. The same can be pretty much said for the previous quarter as well. Now, whether or not you use this in your analysis, that is fine, but just always do your own due diligence. Don't copy if insiders sell, don't sell. If institutions buy, don't buy. Always look at the data before making any decision as a complete whole. Now, what we also want to point out is we have released yesterday our latest free weekly article. We've run through 12 undervalued dividend stocks. We've used some criteria to identify some very high quality ones. If you want to have a look completely free, do click on that pinned comment below. It does also give you access to all of these other articles that you can read for free. For example, if you want to know all the websites we use on the channel, you can click on this article, How to Find Undervalued Stocks, to show you. Now, let's move into some of the meat, the actual underlying metrics. Now, dividend safety, typically we would have a score. Today we don't have one, given the fact, as we can see, they have only recently started to pay a dividend. Yield is just over 1%, market cap around 8 billion. It is a mid-cap company. Now, what we're going to take a look at here is the free cash flow payout. This is just to signal whether or not we can see increasing dividends. And as always, free cash flow data, if possible, over the earnings, as this is susceptible to manipulation by management through accounting. 23% looking very healthy. As always, below 60%, that will give us faith they can offer double-digit increases. 2024 anticipated around 29%, so I wouldn't be surprised if their next increase is double digits. It is definitely something that they can afford to pay. Free cash flow per share, well, one of the best in all honesty in terms of the growth. Very consistent, and it has been increasing over the longer term very strongly as well. And look, in 2024 it is anticipated to increase again, so there's nothing really bad to say with this company. It just comes down to whether or not you think they can sustain this over the longer term, and again, that is why we do use a margin of safety in our valuation that is coming up shortly. Now, this is another thing that you need to understand with the sales growth. They have had double digit every single year, but obviously it is very clear it is in a downward trend. 23% in 2023, 18% on a trailing 12-month basis. Question is, can they sustain this? As we saw just over the more recent quarter, Q1 of 2024, they have around an 11% increase to the same quarter from 2023. Now, will that start to drop down into the single high digits? Again, something we need to factor in. And as we can see, their total sales over the longer term, what we did look at in a different format earlier. Shares outstanding, what we're looking is for share buybacks, reducing the share count, therefore returning excess cash to investor pockets. Now, depending on where you bought, if you bought in 2014, you would have already seen around 900% increase to the share price, but you would have been diluted as a shareholder. If you had bought in 2016. Well, since then they have been buying back shares, although very inconsistently. So not much to talk about on that topic, but just something to consider maybe for other companies you do hold. ROIC then, very important. Remember, gives us faith management are able to effectively allocate their capital. 10% or more, been above that every single year. In fact, from 2020, where it did drop substantially, it has been increasing. 37% on a trailing 12-month basis. This does look like a very strong company, and so far there are no glaring signals as to why this company has dropped down 50% over the last 12 months, although you could argue whether or not this company is now slowing down from the fast growth we saw not too long ago. On top of that, we see operational efficiency. Now, it has increased over the longer term, although it was a period where it was going around the low 30%. Since then, it has come down, but on a trailing 12-month basis, it's looking to make a new high on the margins. A very good sign, something that we can keep an eye on. But if they can continue to increase their top line double digits and increase their margins, then this will be a very strong company to consider for the portfolio. We then move on to the free cash flow margin. We want to see a minimum of 5% in all reality. We can see a lot better and a lot consistent in the more recent period. So again, another good plus. Net debt to EBITDA. Now this is effectively the earnings before tax, interest, depreciation, amortization. And what we always say is these are the number of years it would take the company to pay off all of that debt net of cash on hand. And remember, this correlates to the balance sheet strength as well as dividend safety. Zero, I mean, this year, last year, next year, a very strong balance sheet, definitely one that you should really consider. And now we're going to get into the really important part. If you do believe it's a high quality company, let's get to the valuation. And as always, if you enjoy the content, values being provided, smash that like button, help that subscribe and bell button so you are continually notified of these videos as they drop, and it does really help with the channel. Now let's jump into the first model. Now it is Graham's valuation model. Typically this is one that we do use on more mature companies, but you can argue if you want to be more conservative, we can use it in today's episode. We have the stock ticker symbol, the earnings per share, the long-term growth rate, and the AAA corporate bond yield, giving us an intrinsic value in today's episode, showing overvaluation. Now it comes to 122. We have a market value of 146. But do remember, we don't look at any one of these models purely in isolation. The second model is the multiples valuation. So these are companies in a similar sector and size with their forward PE. We have the average PE, the earnings per share, and we can see the intrinsic value in today's episode showing a massive undervaluation signal. So right now we have two contradicting signals. Now typically the dividend discount model would be the third model we use. It doesn't seem to be relevant given they just started to pay a dividend, but over the next few years we can incorporate this within our Paycom analysis. We then move on to the DCF model, discounted cash flow with the free cash flows year on year. Average growth rate has been very high, 60%, as we saw earlier, not just previously, but also they're forecasting some very strong growth. We've gone for what we believe to be reasonable at 12%. That is lower than the last 3 years, as well as lower than the average growth. With the discount rate, we get the present value of future free cash flows and terminal value. Add the cash, subtract the debt, get the equity value, divide by the shares outstanding, and as we can see, an intrinsic value of just under $200. Now, the intrinsic value in today's episode is the average of these three models, and again, we have been a bit more conservative. We have included Graham's valuation if you do believe the growth will start to slow down. And don't forget, you can grab a copy of this model by clicking on the pinned comment below, running your own numbers through, whether it's for Paycom, if you believe we should include this model or not that model, or if you want to use this for other companies in your portfolio or on your watch list. So an intrinsic value of $186, margin of safety, remember, as always, we start off with 10%. We execute on that if it meets our three criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that for Paycom, well, it is a buy up to 168. Then we keep going realistically till it's near the current trading price. In today's episode, up to $149, it does sit at a 20% margin of safety. At 25%, it isn't quite there yet, around $140. So we would say on our estimates and judgments, the MOS for today sits between 20 to 25. In terms of Wall Street and their expectations, well, they have a share price target of $192. They believe it to go higher than our intrinsic value. They do see upside of 32%, but just bear in mind this one thing: Wall Street have been lowering their target price as the share price is coming down, and it is something that I do believe that they will continue to do. If Paycom continues to fall, they will continue to lower their price. If it continues to increase, like it has done today, up around 1%, then they may continue to increase their forecast. So do take that with a pinch of salt. Purely on our analysis though, we do see a 20 to 25% MOS level. In my opinion, that does look sufficient enough to look at this company as one for the portfolio. Lots of high quality in all of the metrics, the ROICs, the increasing margins. When we look at their debt levels, increasingly low. Their revenues consistently increasing, their bottom lines increasing. The main question here is, do you believe that the growth will continue, and at what margin of safety are you satisfied for future for this company? In terms of what I'd say, for me personally, this is one that you could dollar cost average depending if that's your strategy or not. And also, as we saw, free cash flow does continue to increase over the next year as anticipated, and you get double-digit growth on the earnings per share over the next 3 to 5 years. As always though, do let me know your thoughts in the comments below. Is this one maybe you're looking to add, maybe one on the watch list, or maybe it is one that you're looking to sell depending on your reasons? As always, if you enjoyed today's content, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.